Okay, so we're going to talk about some of the advantages and disadvantages to contributing to a qualified retirement plan. So let's start by talking about some of the advantages, and then we'll talk about the disadvantages. And we're going to start by introducing our next individual, Casey Summit.
Equivalents have a maturity of 3 months or less.
So let's say that you're a tax planner for individuals, and one of your clients, Casey Summit, comes to you with the one goal in mind: to reach her peak wealth potential. Okay, so part of doing this suggests that she wants to minimize the amount of taxes she has to pay the IRS. We're going to discuss the fundamental aspects of qualified retirement plans, the concept of pre-tax contributions, and when we say pre-tax, we're referring to the money that's taken from your earnings before taxes are applied. So this means that Casey is effectively lowering her taxable income. All right, so let's say Casey earns $5,000 bi-weekly. Okay, so every 2 weeks. Typically, if she received this as a paycheck, taxes would be calculated on the full $5,000, potentially reducing her take-home pay significantly, right? So let's say that she is going to reduce this down to $4,000, depending on her tax rate. Okay, so we're assuming that she has a 20% tax rate. However, if she instead contributed this $1,000 of her earnings every 2 weeks to a qualified retirement plan like a 401k, then this contribution is made before any taxes are deducted. Now, instead of being taxed on the full $5,000 on her paycheck at, let's say, this 20% rate, she is instead taxed on $4,000. Okay, so if she does not contribute to a 401k, the $5,000 in income times the 20% tax rate means that she owes the IRS $1,000. But if instead she did contribute $1,000 to this qualified retirement plan, right, the 401k, then we would reduce this amount, right? It would be deducted. So $5,000 of income minus $1,000 in contribution to her 401k would mean that she has $4,000 in taxable income. Okay, so now $4,000 is applied to the 20% tax rate, and she now owes $800 to the IRS. Right? So $200 less each paycheck is getting paid to the IRS. Instead, that $200 paycheck is growing in this investment account tax deferred. Tax deferred meaning eventually she'll have to pay tax, but just at a later date when she takes it out. Okay, so the $1,000 that instead went to the 401k isn't just sitting idle. It's invested in a trust account where it can grow tax deferred, meaning that no taxes will be paid on the investment as long as they remain in the account, allowing the savings to potentially grow more rapidly than if they were taxed annually. Okay, so this is a powerful advantage for Casey. So there are various advantages to Casey contributing to a qualified retirement plan, right? Making these powerful tools in her financial strategy. So these are going to provide benefits during her working years, into retirement, and even after. Okay, so this can also impact her future beneficiaries. So what do we need to know? Well, some of the additional advantages by using qualified retirement plans include tax deductible contributions, tax deferred accumulation of earnings, asset protection from creditors, and even avoidance of probate. Okay, so tax deductible contributions, right? Beyond the pre tax contributions we discussed, Casey can also benefit from tax deductions. So, for instance, if Casey is self employed and contributed to a SEP IRA, those contributions can be tax deductible, effectively reducing her taxable income for the year. So, when it comes to tax deferred accumulation of earnings, the earnings on Casey's retirement plan investments are not taxed year by year, right? Instead, the tax is deferred until Casey withdraws the money at retirement. So, this allows the investments to grow without the immediate burden of taxes, potentially increasing the compound growth. So, asset protection from creditors. Qualified retirement plans often provide legal protection from creditors. So, what does that mean? This means that in the event that Casey faces financial difficulties, the assets in her retirement plan are generally safeguarded against claims by creditors. So, what does it mean for her to avoid probate? Okay, so finally, retirement plans like Casey's 401k or IRA are designed to transfer assets directly to a named beneficiary upon Casey's passing. So this means that these assets can bypass the often lengthy and costly probate process. The beneficiaries can receive these assets more directly and privately without the retirement account becoming part of the public record. Okay, so this would generally be avoiding probate court. So while Casey enjoys several benefits from contributing to a qualified retirement plan, it's also important to consider the disadvantages that come with these plans. Firstly, when Casey eventually starts taking distributions from the retirement plan, that income is going to get taxed as ordinary income, not as long-term capital gains. So this means that the favored tax rates that typically apply to long-term capital gains held for more than 1 year will not apply. So for example, even if Casey's retirement within the 401k has grown for several years, any withdrawals will be taxed at her regular income tax rate at the time of withdrawal, which could be higher than the long-term capital gains rates. So if Casey instead just put all this money into a investment account, right, a normal brokerage account, then these would generally be taxed at long-term capital gains rates if she held them for over a year. Okay, but we're doing a tax saving strategy, so this is going to a 401k instead. Another disadvantage is that the assets in Casey's retirement plan are not liquid. So this means Casey cannot easily convert these investments into cash without facing potential penalties. Right? If Casey decides to take the money out of her 401k before reaching the age of 59 and a half, she may have to pay a 10% early withdrawal penalty on top of the ordinary income tax. So this is designed to discourage individuals from using their retirement savings prematurely. So there are, however, a few exceptions to these rules. Certain circumstances, such as first-time home purchasers or medical expenses, may qualify Casey for a penalty-free distribution. But the specifics of these exceptions can be complex and have their own qualifications and limitations. So it's critical for Casey to understand these disadvantages so that she can tax plan accordingly. In the United States, there's this wide array of qualified retirement plans available, but four stand out due to their popularity and distinctive features. So we'll focus on these to give you a well-rounded understanding of Casey's options. So let's start with the employer-sponsored section 401k plans. This is a favorite for many, including our example taxpayer, Casey Summit. In a 401k plan, Casey agrees to contribute a certain amount of her pre-tax earnings, and her employer matches this contribution up to a certain percentage. So it's like getting a raise for your future self. The employer's match is essentially free money, contributing to Casey's retirement pot. So moving on to traditional IRAs, they come in two flavors, deductible and non-deductible. With a deductible IRA, Casey can contribute pre-tax income, which reduces her taxable income for that year. However, all withdrawals from IRAs during retirement are taxed as ordinary income. In contrast, contributions to a non-deductible IRA are made after tax dollars, meaning she's still going to pay tax before she makes the contribution, and they do not provide an immediate tax benefit, but the account's earnings still grow tax deferred. So annuity contracts are agreements between an individual and an insurance company. So Casey can contribute after-tax money into an annuity, which then grows tax deferred. Upon retirement, she can draw an income from this annuity. While annuities provide a steady income stream, they're often complex financial products with various fees and terms that Casey must understand. So lastly, Roth IRAs offer a different tax advantage. All right, this is my personal favorite. Unlike a traditional IRA, Casey's contributions to a Roth IRA are made with after-tax dollars, meaning she doesn't get a tax deduction up front. However, this is where the magic happens. When she starts withdrawing funds in her retirement, those distributions are completely tax-free, provided certain conditions that are met. But this is particularly advantageous if Casey expects to be in a higher tax bracket in the future. So each of these plans have nuances in terms of contribution limits, withdrawal rules, and tax implications, all of which are essential for Casey to consider as she's planning for this financially secure retirement. All right, so employer-sponsored retirement plans are a cornerstone of retirement savings in the United States. They fall into two broad categories, defined benefit plans and defined contribution plans. Defined benefit plans are traditional pension plans. They promise employees a specified monthly benefit at retirement, typically based on factors like salary and years of service. The beauty of defined benefit plans is that employers bear the investment risk. So this means that regardless of how the plan's investments perform, the employee will receive a predetermined amount upon retirement. Government employees and school teachers often have access to these kinds of plans. So we're going to think of this like a financial guarantee from your employer for your golden years. On the other side, we have a defined contribution plan, of which the 401k plan is perhaps the most well-known example. These plans do not promise a specific benefit at retirement. Instead, the employee and often the employer make contributions into an individual account for the employee's future use. So the contribution amount is defined, but the eventual benefit depends on the account's investment performance. So here, the employee bears the investment risk. The value of the retirement account will fluctuate based on the capital markets. It's like you're steering the ship of your retirement savings, with the potential for higher rewards, but also higher risks. So what sets these employer-sponsored plans apart from IRAs and annuities? This is that it has the potential for an employer to match in defined contribution plans and promised benefits in defined benefit plans. So these employer contributions can significantly boost an employee's retirement savings, which is not a feature typically found in IRAs or annuities. So in comparing defined benefit and defined contribution plans, it's like comparing a promise to a potential, right? With defined benefit plans, you know what you're going to get, which can be reassuring. With defined contribution plans, you have a chance to accumulate more based on your investment choices and market performance, but you also have the uncertainty of not knowing exactly how much you will have when you retire. So let's dive a little bit deeper into these employer-sponsored retirement plans. And let's specifically understand now how they are funded. So employer-sponsored plans can either be fully funded by the employer, the employee, or a combination of both. In a defined benefit plan specifically, these are typically funded by the employer as the sole contributor. So they commit to funding the employee's retirement plan entirely, and the employee doesn't have to contribute to receive the defined benefit upon retirement. So it's a one-sided affair where the employer takes on the financial responsibility. In a defined contribution plan, like a 401k, funding can typically come from the employee's contributions, which are often deducted directly from their paycheck. But here's where it gets interesting. Many employers often match their employees' contributions up to a certain percentage. This match is a powerful incentive for employees to participate in the plan because it's essentially free money toward their retirement savings. All right, so Casey Summit, for example, can contribute 5% of her salary to her 401k plan, and her employer might match this contribution fully or partially, significantly enhancing her retirement savings. So some plans may also include profit sharing features where the employer can make additional contributions based on the company's profitability. The beauty of this system is its flexibility and the incentivization of saving for retirement. So Casey's contributions are pre-tax, reducing her taxable income, and the employer's match amplifies her savings without any additional tax implications at the time of the contribution. So thinking a little bit further about defined benefit plans, and these are often known as pension plans, and they are often a type of employer-sponsored retirement plan that provides a clear, predictable benefit to employees upon retirement. So this benefit is typically a specific monthly payment that starts when the employee reaches their normal retirement age and continues for the rest of their life. Okay, so the amount of the benefit can be determined in one of two ways. It can be a fixed dollar amount. So some plans promise a set dollar amount each month. For example, Casey Summit might be entitled to $1,500 per month upon retirement, no matter how the plan's investment performs. So thinking about the defined formula, more commonly, the benefit is calculated using a formula that takes into account factors such as the employee's age, their salary, and the number of years they've worked for the company. So this might look something like 1.5% of Casey's average salary over her last 5 years of employment times the number of years she worked for the company. Defined benefit plans are particularly valuable because they offer security and simplicity for retirees. So you know what you're going to get, and you don't have to make more complex investment decisions as you would with a defined contribution plan. However, these plans are becoming less common as the responsibility of the risk of funding retirement shifts from employers to employees. Okay, so defined contribution plans represent a modern approach to retirement savings, where the focus is on the amount contributed rather than the ultimate benefit received. In these plans, employees like Casey Summit have individual accounts into which they and possibly their employers can make contributions. The key here is that the contribution amount is predetermined, but the retirement benefit isn't guaranteed. It's determined by the account's performance in the market. So that means if Casey's contributing to her 401k, she decides how much she's going to put in within the limits set by the plan and the tax laws, and her employer may match a portion of that contribution. So Casey's account will grow or shrink based on the investments within the plan, which puts her in the driver's seat when it comes to managing investment risk. The plan's value will ebb and flow with the tides of the market, making it essential for Casey to consider her risk tolerance and retirement timeline when making investment choices. This type of plan encourages proactive retirement planning and offers the potential for growth, but it also requires employees to have a hand in managing their retirement destiny, unlike defined benefit plans, where the employer promises that fixed amount.